Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner, and this is where we do our very best to keep investing simple. And I'm joined by Corey Halliday and Noah Davidson, and just grateful to have you guys with us. So thanks for coming.
Excited to be here.
I'm loving the studio. It's awesome.
Yeah,
we're trying to up the podcast game, I guess. You know, so you want the good news or the bad news?
Always hit me with the bad news first.
So the bad news is we're in the top 1% of podcasts worldwide. And what that sounds like good news? Well, that means you're in the top 1% out of 3 million.
Yeah.
That means we're somewhere in the top 30,000.
We're in the
I
tens
like our
of
chances.
thousands.
I like our
I guess
chances.
that's good and bad news. So.
Are we growing?
We are. That's what's funny is we're growing because I'll tell you about the podcast. I didn't want to do it. I did not want to do it. Mike talked me into it. He said, we got to do a podcast. No one's going to listen to us.
Yeah.
No one's going to listen to me anyway. And I'll tell you what I loved. We've done it for 5 years now. And I'm blown away at the listenership. Blown away. Never thought that we'd have people paying this much attention. But what it's been great for me is I've interviewed all these PhDs and all these guys from government, all these authors. The learning has been absolutely phenomenal for me, just the learning of it all. So I can see why people would listen because I'm listening to them, and it's certainly worth my time to listen to what they have to say. So it's been great stuff. So today's topic, we're lucky. We're going to introduce Corey a little bit, and Corey, you can lead this discussion or just be more verbose. He's the smartest guy in the room most of the places he goes, and he doesn't say much. Noah, he just cracks jokes all the time. So, but Corey, some people in the markets, they'll get, in the United States, they get what's called a Series 7, and that's a big, long test. Takes most of the day to take it, and if you pass that's a minimum competency test where you can now be a broker. You can make trades for people. Then you have what's called a Series 65, and that's an easier test, and that's, you got to get like a 76 on it. I don't know what it is today. It used to be a 70 or something.
Yes, 70%.
And it's a couple of hours to take it. It's kind of interesting because there's not that there's a lot of law in that test. What was this 1934 Act and all that stuff. But you can take that test a couple of hours. And what's crazy is you can manage hundreds of millions after that. You can be a hedge fund manager. But Corey went and got what's called, after those, he got a Series 4. So talk a little bit about your journey, Corey, because what we're going to be talking about today is a really important topic, which is risk. We're going to talk a little about risk. And Corey and Noah, these are the two best risk managers that I know.
Yeah, so Series 4, like you talked about, I did take other licenses, Series 7 and such, but worked my way up the ladder and got a Series 4 option principal, which is the head of option trading at the firm. And I did that for a number of years. And over that time, if you're familiar with the options market, it's a way to manage risk. In fact, the options market was created for that purpose. So the two most common option things that you can do that people will do is sell calls or buy puts. And buying a put option is an insurance contract. So anyone that's bought or sold insurance is understanding of this, kind of understands how insurance works. If I go out and I buy car insurance, I'm insuring the value of that car against damages. So now if the car goes down in value, gets in a crash, well, I can take that little piece of paper, essentially that insurance contract, and say, hey, you have to reimburse me for this. And we can do the same thing. That's what a put option does, is if my stock goes down in value, I have this put that I can trade in for money and say, hey, you have to reimburse me for these losses. And so that's why the options market was created. And I think that the options market is absolutely critical to stock investing.
I wouldn't do it. I wouldn't trade stocks if I didn't have options.
Yeah.
But let me ask you this: as you're trading, how many guys are you managing at this time? I want people to have a good sense of your
business.
Business.
Hundreds of traders at a time.
So they're all trading accounts and options. And what are you doing? How are you managing these risks?
Yeah, so we're managing risk. Now, back when I did it, this is years and years ago, so we didn't have quite as much technology. In today's market, you can do a lot of really cool technological things. There's something called VAR, value at risk. So you can run analytics that tell you, okay, if the S&P 500 goes down 5%, this portfolio is likely to do this based on the way it's constructed and its beta and so forth.
You would beta weight.
Yeah, you beta weight and so on. And we would do that, but we would do it manually. And so we would have to do calculations and things and go in there and calculate deltas. And a lot of the stuff that we did was manual, which was fantastic from a learning environment. And that's how we teach our students now, right? We make them draw risk graphs on pieces of paper so they can learn how this works. And we do that in our coaching programs. We will teach you how to draw your risk graphs, and all of a sudden somebody goes from not knowing anything about how to manage their risk. They can draw a risk graph on a long stock plus a protective put position, and all of a sudden it makes sense to them. Hey, now I have limited risk. I can only lose a couple $100 if this goes wrong, but I can make thousands on the upside, and they start to see that power, and then the education really falls into place.
Imagine buying real estate with no insurance. And the thing about real estate is you can insure real estate against fire and against theft, against flood if you want to pay extra, but you really can't insure real estate against a price drop. You have to endure those, and it's not liquid.
Right.
So the idea of having a liquid market, I mean, I personally, I'm not a real estate expert. I love my real estate, but there's ways I could hedge it. I could get the IYR, and I could hedge with some paper. I'd know how to do that. But the funny thing about when you learn that skill like Corey has, the ability to lock down risk when you have a graph and you see up, down, sideways with the price, and you got to lock down, you sleep at night. And 401k people don't have this. Day trader people might have this, some of the more sophisticated. But the ability to lock down risk is a huge thing. So Noah, you pipe in here. You're a risk taker. Now, wait. Not to digress. Wait. Should we not have Noah on this podcast?
Yeah.
Okay,
my risk taking is questionable.
Okay, here's a man, like, as long as I've known Noah, like, he's never all been in one piece, ever. Like, the whole time I've known him, he's a skier, he's a hiker, he's a rock crawler, he called me one time and says, hey man, I'm not gonna be at this meeting. I go, you're kind of in and out. He goes, yeah, I'm on top of a rock trying to get my cell phone, here. Yeah. I go, what's wrong? He goes, well, my wheel on my Jeep is missing, in a rock. So not too long ago.
As we speak, he's got a broken hip, right?
He's busted. I mean, like, not just like a hip, like the whole, the anatomy is called the iliac crest. I know that from my anatomy days. And I mean, the guy I'm lucky you're here, man.
I'm lucky I'm
because he hit a tree. He did a Sonny Bono.
That tree assaulted me, to be fair.
But yeah, it moved in front of you. That tree, man,
came out of nowhere.
Moved right in front of me.
Did you make a big mark on the tree? Did it show?
I haven't been back to look, but before the snow falls, I'm going to go back and see. Well, I got to go find my missing ski pole.
I'm not kidding. Yeah, a total yard sale. See, I know the lingo. It's a yard sale. When you go skiing and there's skis, it's like your yard sale.
Yeah.
So, but here's the thing. He has a knee operation. And he calls me like 5 days later. Where are you? He goes, I'm up skiing. I go, you just had a ACL reconstruction. So I don't know that you should be talking about risk.
Well, there's risking your money. That's a totally different topic.
Risking your life.
And get a little thrill seeking from time to time is okay. And a lot of people, they take their thrill seeking behavior into the financial markets. And I have to admit, part of my risk management skill that I've developed probably came from being a bit of a thrill seeker with money, trying to get rich quick, trying to learn how to turn nothing into something, and overuse leverage and things like that. And so Corey studied risk in the textbook. We'll go with classic.
Me and Noah just lost all our money.
I'm like, wow, that sucked. I better not do that again. So
we just lost our money. Yeah. So here's some thoughts. I give a lot of credit to one of my mentors, Robert Kiyosaki, and I remember this really vividly. And when he said this, I was upset with myself that I hadn't noticed the obvious. I thought, he has moments like that where he'll draw something on a flip chart. You're like, I should have known that. That's simple, and yet you didn't. But he said, and this is what I've taught my sons. the first risk lesson I gave him was this one. Risk is related to control. Risk is related to control. So when you buy a house, maybe you're a house flipper or whatever, well, okay, I can control a little. I can force some appreciation in that. I can, put in new appliances. I mean, Kenny McElroy or Than Merrill will go into a project and say, all right, the management can be upgraded. The appliances can be upgraded. We can paint it. We can put in a carport, whatever. And they can force appreciation, charge more, raise your NOI, help your cap rate, the whole bit. I think that in the stock market, you don't have a lot of that stuff. If I buy Apple, there's really nothing I can do to boost the sales of Apple to help their technology. I don't know how to build phones, right? And as Corey said earlier, that's why the options market is so important, because it gives me the choice. In other words, for option that starts with a C, it's choice. And if I can have the choice of where I want to buy, and I have the choice of where I want to sell, and I can preserve that choice, that re-enthrones, to a degree, some control. And that's why I think the options market and the stock market are inextricable. People say options are risky. Quite the contrary. Options preserve your choices when things get rough. So you want to talk about that?
It's kind of like saying fire is risky. Yeah, it is. But it's also like the one thing that
power.
It's power. Yeah, absolutely. And from, in my experience, I went through this phase of, I could just become a really good stock picker, and I could become a really good technician.
Okay, this is big. This is big.
Yeah.
Everybody thinks it's about predicting the future.
Yes.
Yeah.
And if I could just hone those skills, I could make all kinds of money. And after I learned how not to do things and how to take inappropriate risks where I didn't have control, the biggest light bulb was when I all of a sudden understood, options help me regain that control. And my confidence shot up, not in my ability to pick a stock, it was in my ability to mitigate the downside risk if I was wrong. And that was huge for me. That was a big, big, big moment where I was like, I get this. And from there, it just became all about, okay, if I'm going to buy this stock, well, how am I going to manage the risk? Or if I'm going to sell that put, what am I going to do to manage the risk? And then everything became oriented around that risk management. And then that, made all the difference in the world in the amount of traction I got.
And that's because people are built to be consumers, right? And so when most people learn about the options market, they think, well, I'm going to go out and buy options, which we will teach you is literally the most risky thing you can do, in that if you're just speculating on price direction and you've got time decay, these are some fancy terms, working against you, basically you're buying a deteriorating asset and you have to have a big price move in a short period of time in order to make it out alive. Yeah, and you got to be right. Well, that's very risky. That is true, but that's high risk strategy. And it's the first thing that most people will do when they enter the options market, even though it's the worst thing they can do.
Well, it's the most seductive thing. Because it's high percent yield if you're right.
Yeah.
And it's a good feeling when you win.
It is. It's that greed gland.
But it's a lousy feeling when you get taken out behind the proverbial woodshed and given a severe beating by the options market.
Yeah.
It doesn't feel good. But then you learn how to flip that around.
Exactly.
So your first principle that I share is that your risk is about control. So what a listener could do is you look at where all your money is and you say, how much control do I have over what happens? For example, with 401k, there's not a lot of control there other than participating or not participating. Oh, they'll let you tweak it, but most people don't know how, right? They wouldn't, and some don't let you tweak it very often. Here's the thing. So you start with this idea of risk is related to control, and then you start to graduate and you start to be able to name very specific risks that you can see. For example, people say, well, diversifying your 401k, you're diversified, as if that was a solution to risk. No, there's two types of risk here. There's something called systemic risk, where the whole system melts down. Your 401k is toast. You're wiped out. You're dead. You're toast. Non-systemic risk, remember the BP? This is the one I always put in my book. It's BP, it stands for broken pipe now instead of British Petroleum,
right.
Broken pipe. But BP breaks a pipe in the Gulf, right? They break the pipe, and their stock was at 60, it goes to 30, cut in half. All the other stocks are fine. So everyone says, well, If you only had 1% of your money in BP, you only lose 0.5% because only 1% of your money is in you diversified. Yeah, but a few years later, you have the subprime meltdown. S&P's cut in half, and that diversification, rather than being like Buffett where you were selective, diversification crushes you. It crushes you because of systemic risk. So if a person, my humble opinion, if you're in a 401k and you're diversified, but you don't know what systemic risk is and what non-systemic risk is, you got no business investing in things that you don't understand, which is ignorance risk might be the biggest one.
Well, and you take the example of 401k. You're an investor, but really you're a spectator because you are handing that control over.
Yeah.
And you are not in charge and in control of your money. You're kind of observing what happens.
Garbage.
And then they say, well, if you diversify, well, the rate of correlation in the financial markets is so high. I learned this from an old options trader that used to work on the CBOE. He sat down. He's like, oh yeah, we've run all the models. Stocks are 80% correlated. Blah blah. It's kind of going off. It's like it doesn't really matter. If you're overly diversified, you could just buy the S&P index and probably outperform the person trying to pick the best stocks. And there's a certain amount of truth to that. And diversification as a principle is really, really good if you diversify asset classes. That's, real estate, business, stocks. Like you're not in the same asset class. But stocks in and of themselves, yeah, you can diversify, Apple, Google, they're all tech at a certain point, at a certain level. They're all paper assets at a certain level. The systemic risk you talk about is that one thing that, the black swan event that everybody's always worried about. But the cool thing about the option markets is, yeah, you can diversify or you can concentrate your effort if you know what you're doing. And so this is the old Warren Buffett quote. Diversification is a hedge against ignorance. And then don't put all your eggs in one basket. Well, you can put your eggs into one basket if you know how to watch that basket.
If you control
closely.
the basket.
Yes,
yeah,
absolutely.
and he's put a lot of his eggs in Apple, right?
Yeah,
He's
half.
40% of his portfolio, right?
Yeah.
Like
in Apple, a tech stock, and he always talked about that he avoided. Well, I guess Apple's not exactly pure tech; it's consumer, and that was his argument. Was look, I realized that people were not going to give up their cell phones, and they'd rather have a cell phone than a lot of other things like food on the table in some cases.
People used to, I love real estate because it's a necessity.
Yeah.
People always say, well, paper, that's not a necessity. I'm like, homeless people have cell phones, man.
Yeah.
Everyone's got
Well, I'm of the opinion that Apple sells dopamine. They don't sell. Everything they do gives me a fancy new phone. Opening it with a package, that's a dopamine hit.
Yeah.
I get
Load
that
your
text
Instagram
message,
on there.
Dopamine hit. I can make a click to pay Apple Pay.
Addicted
Dopamine hit. Apple TV. They got some good programs on there now. They're getting money from people hand over fist just in consistent consumption of their the products they produce.
So back to risk, Corey. You made your living as a risk manager. Isn't it astounding that with the options market, the amount of control you can really get over trades? Do you think that would be surprising to people? Talk a little bit about the epiphanies you've had with people that you've coached, where they have all of a sudden they realize with some knowledge, it's like simple stuff. For example, I'll bet you most people don't know that a cash secured put is less risky than owning the stock.
Yeah. And
I don't know that.
That's a perfect example. So I could go out and buy a stock today and pay current prices, and I immediately start participating on the upside, but I lose on the downside. Yeah. I can sell a put to buy the stock at a future date and get paid to do it. And that future price is at a discount. So as you think about that, wait a second, I'm getting paid money to buy the stock cheaper than it is today. So if I like this stock, I'm getting somebody to pay me, and Warren Buffett does this strategy.
How opposite of a 401k is this?
Yeah.
How opposite is it? If you draw a financial statement and you want to put an asset in your asset column and you're paying a fee to do it, it's taking money out of your pocket to buy the asset. Cash, the first stocks I had my sons buy, I had them use that strategy because get paid to buy. Think about that. Get paid to buy and get paid to buy at a discount.
It's incredible. Think if you can think of stocks sort of like land. It's something that most people, when they buy land, they're not cash flowing it, right? Land doesn't have any income. It's just, well, I think that land is going to become more
playing the cap
valuable
gain.
in the future.
Playing the
Right.
cap gain.
It's a capital gain. So you can buy that land, but you could enter into a contract that says, well, the land is worth $200,000. I'll pay $180,000, and you have to pay me $5,000 to buy it from you at $180,000, a couple of months from now. So you're getting paid to own the asset you want at a discount to its current value.
Yeah.
That's first and foremost. But then secondly, if you end up purchasing that asset, the land or the stock, say it does go down and you end up owning it, well, now you can cash flow it. And this is a big part of the Cashflow Academy. Now I can go out and write some options, and I can have somebody pay me money to take ownership of that stock from me, but at a higher price than where I paid for it.
Getting paid to buy low,
So,
getting paid to sell
Getting
high.
paid to buy low, getting paid to sell high. And then a lot of times we buy these stocks as investments. So a lot of people don't understand as an investor, this is huge for you because you get paid to own it cheaper. And then if it is going up towards that exit price, we can use risk management to roll those options out to basically not end up selling, to raise that exit price and keep dangling the carrot out there so they can't
This
take
is
it.
exciting stuff, but what's happening right now for a lot of folks who are listening to us, I mean, our regular crowd, they know what we're talking about.
Yeah.
But if there's some new folks here that aren't, familiar with the lingo, their minds are just like, I can get paid to do what? I can get paid to do what?
I should have read the book, man.
Well, I know, but Andy, you always do this. A really great example. You just talk about contracts. Rich people use contracts to buy things. They use contracts when they sell things. The contracts protect them. They use contracts to secure value. So, I mean, an option is just that. It's a contract that we can use.
But it's a special contract.
Yeah.
And that brings us to another thing on risk. One of the risks that I think people underestimate, and I'm the worst at this, I've learned this through sad experience, is something called counterparty risk. Pensions have huge counterparty risk. The government, Social Security, has counterparty risk, even though they can print money. Counterparty risk means someone else has control, not you. It's back to risk and control. And it's interesting. I had a old basketball buddy, text me, and he says, "Hey, work's been slow down my luck. I need to help my son. I'd like to borrow some money. I'll have it back to you in 3 weeks," or whatever it was. And I showed my wife the text. Of course, there it starts, man. She rolls her eyes. She's like, she goes, what she says? She goes, "Just give it to him because you're never going to see it again. And if so, it'll be after 6 months of you calling him on the phone, And she's smart.
Yeah.
And it isn't. And I said, "Sweetie, it isn't that they don't. It's not like they're blatantly dishonest when they fail to keep those promises. Like he had what we call good intentions, but you don't have the ability. So when you look at contracts, be careful because a bank will have a contract with you, and in that contract is called collateral. Because so many times you'll hear this risk of, sweetheart, I know I promised this, but XYZ happened. It's beyond my control. I didn't know it was going to happen. Well, if you have a pension or even a 401k, they'll promise the world. They promise the teachers in Kentucky stuff, CalPERS in California promising stuff. Just because someone's promised you something, well, great. You can say, well, they broke their promise. Yeah, but you're still poor. You're still out. So when you become more savvy with risk, part of the nice thing about options contracts is, the person on the other side of that, it's really the control of market makers and clearinghouses, and you have to have collateral. You have to have sufficient funds. I mean, those contracts aren't solid because they're promises. They're solid because they're backed. You want to talk about that?
Yeah, I mean, not only is it backed by the person that's doing it, but if they can't fulfill their promise, then it goes to the broker.
The brokerage will fulfill it.
The brokerage fulfills it. And then if they can't, it goes to insurance. So these contracts are legally binding, and they're always paid, which is a huge deal.
Well, so that kind of makes your job when you were running the option 4 principle really interesting because you had traders taking risks, and and of course you're there to say, well, hey, hold on here. That would put the institution at risk, and so that's several layers of protection. That's really, really cool to think about.
Yeah, exactly. And so when people say, well, is this legally binding contract? What if the person on the other side doesn't deliver the stock or whatever? No, it's legally binding. It will happen. In fact, there's an auto exercise that takes place where if an option is left in the money through its expiration, it automatically happens. It's not up for debate or something like that. And so it happens. And these paper assets, I mean, again, they're insured by entities as well, up to a certain amount. So your money at a brokerage account, not only do you have money that's insured like it would be in a bank account, but you have assets that are insured. Your stocks and your financial assets up to a certain amount. Now, if you get beyond that, and this is why I have multiple accounts at different brokerages all over the place. I've got a TD Ameritrade, Thinkorswim. I've got the Interactive
IB.
Brokers. I got Fidelity. I've got accounts in multiple places because I want certain insurance or I want certain tools and things like that. So there's education that's involved in understanding that. But interestingly enough, it's not that difficult for people to understand. It's one of those things where if you have the desire to learn this, the majority of people have the ability. It's just a question of desire.
Well, I'll fully admit, when I first encountered options, I was extremely intimidated by them. Like I just looked at the
They're new.
Just the spreadsheet of all the strike prices and quotes and bid and ask, and just the sheer amount of numbers just intimidated me. And after I spent some time with them and I started understanding the concepts, I started understanding the risk graphs, all of a sudden things started to click for me. Like, this is not hard. This is not rocket science. It's actually really, really simple once you understand it, and as long as I don't have to do the math.
So
yeah, and you don't have to. The technology does that for you now. So
yes.
So if you're listening, my question for listener is very simple. What is your approach to risk? Because first of all, no risk, no goodies. There's three approaches you might take to risk. Some people run from risk. I just want to be a risk taker. Even if you go get a job, you risk. The biggest risk you've probably taken in your life is driving a car every day. That's probably the biggest risk you take every day. But because people are familiar with it, they're almost overconfident with that risk, right? The second thing you can be a risk avoider. You could be a risk taker, or you can be a risk manager. I kind of think of this like I'm like Star Trek. I shouldn't bring Star Trek into this because I'm old. And the young people don't even know who the hell's Captain Kirk. But Captain Kirk was a risk taker. It'd be like, and Dr. McCoy was a risk avoider, and Spock was a risk manager. Because we're going to the Klingons or whatever, and Captain Kirk says, "Let's go down there and see what's going on," and the Spock would say, "The odds of survival are 320,000 to 1." And he'd say, "I don't care, I'm going in there. I'm Captain Kirk, I'm going to take the risk." Dr. McCoy was the risk avoider. "Damn it, Jim, do you need a sedative? We're not going down there. Are you out of your Vulcan mind, And then Spock was, the heartless non-human, but we are human. So learn to be a risk manager. Try to be more like Spock and less like Captain Kirk and less that way. Last podcast, you mentioned people being afraid of things. Mm-hmm. And, I would not be afraid of options or real estate. I wouldn't be afraid of debt. Just because these things pose risks, I would not be afraid of them. And you mentioned fire. I'll use sex. But look, whether it's any kind of leverage brings risk to it. And you mentioned fire.
Leverage.
Do you want to go on the sex thing?
Sex?
Let me tell you.
There's a lot of leverage that can go.
At my age, I'm just trying to survive the whole thing. Okay, at my age, but I'm telling you, I just want to watch Sports Center. Can I just watch that? No, here's the thing. It's like I teach my kids about fire, sex, and debt. They're very much the same. For example, fire. It can heat you. It can you're up in the mountains and you'll get hypothermia. It'll kill you before starvation will. Hypothermia will kill you in an hour, right? So the ability to make a fire with that flint and steel or finding, under the pines and all that Boy Scout, you learn how to build a fire, protection, light, heat, wave off the bear. It's life-saving, but it's also life-taking. And so it's just power. So you have a choice when it talks about the risk of fire. Don't play with matches, or learn how to keep the matches dry. Learn how to use your magnifying glass, your flint and steel, and rubbing your sticks together, friction fires. Learn and become a master of the fire. Don't be an avoider of the fire. Same's true. From a standpoint, when I talk my sons about the birds and the bees, I says, when would you be more godlike in your world than when you create another human being? It's an incredible power that's given almost universally, to so many people. And it's one of the most beautiful, most powerful things you can do is bring a life into this world when it's done appropriately, and when it's done with the right person and the right time and the right circumstance in life. It's the most beautiful experience I've ever had is delivering a child. I mean, when you hold your own child in your arms, you're a different person that you can't understand that unless it's happened to you. You're just a different human being when that happens. Well, that comes through that. But if you abuse that power, look how much harm it can do. And if we debase that power, look how much, the degradation of men and women, it can, the prisons are filled and victims everywhere of the abuse of that power. Well, leverage through an option or leverage through debt is exactly the same thing. Options can be the most beautiful risk manager, but if we use them opportunistically, they'll burn your house down, and the same is true with debt.
Well, and there are ways to use leverage safely. Like there are ways to do that.
There's ways to build a fire safely.
Correct.
There's ways to protect yourself and other things, right? Safety, Noah, safety.
Thank you for joining our TED Talk. This has been awesome.
It comes back to knowledge, though.
Yeah. So, Noah, when you're coming down the mountain.
Well, you know what? It is.
This was actually an intervention.
This will be
a
brief moment, and I knew this was coming. But
this is an
risk
intervention.
is related to control, and this is one of those moments where I was pushing and flirting with the edges of control. Yeah. And when I lost control, I paid a consequence. And so I'm so thrilled and lucky to be here. But it did make me reevaluate some of my risk-taking personality traits.
Ladies and gentlemen, welcome to the Cashflow Academy. Today we're going to have an intervention for Noah to save his
You didn't
life.
know that's why we were doing this, but this is
it's all about the
Melanie
risk.
asked us to intervene and change the path of your.
Well, she didn't have to ask.
It's not going to do it.
But no, it is true. This coming back to risk, control, and just making good choices. And sometimes in life we make bad choices and we learn hard lessons. And it's what we do with that lesson, that gives you the ability to keep moving forward.
Now, here's the irony of risk. What happens with infinite return? This is what's really weird. There's this black hole quantum weird thing, because normally you have a line of maybe horizontal as your reward and vertical as your risk, and you have this nice 45-degree line, more reward, more risk, more reward. But here's what's crazy, is there's this weird shift in the universe, this quantum leap thing, that when you do infinite return, you have no risk and an infinite reward. Isn't that really crazy? Because once I have all my money out of the deal, I really don't have any risk. Maybe my reputation is at risk, right? Like Kenny McElrath and Merrill, they don't use any of their own money. They're infinite from day one. They use bank for financing. They use private money for the initial equity to put in there. And they just steer the whole deal without taking any risk at all. And if the thing failed, it would be reputational risk, but no money would be lost. Isn't that kind of a strange idea that the more leverage you use that way, the more OPM you have? And this is what's crazy with the option. Your chances of losing all your money in option is greater than losing all your money in a stock. But here's what's nuts. If I buy a stock, 100 shares at $100, that's 10 grand. But if I buy an option for, let's say, 50 cents, well, that's $50, right? You want to comment on that?
Yeah, I mean, in your example,
close to zero.
Yeah, in your example, the worst that can happen to you is the option is worthless and you lose $50.
Yeah.
If the stock goes worthless, you lost 10 grand.
Yeah.
So from a dollar's perspective, way more risky, right?
But if an idiot puts 10 grand in the options.
Exactly. And so position sizing and all of these things are just critical. And it's not about kind of the thrill seeking of it. This is where education comes in, is we talk a lot about temperament. Your temperament is critical to your success as an investor, as a trader, as a human being, I think. Yeah. Temperament's really important. If you're a very volatile person, constantly up and down and all over, there's going to be a lot of things that you have to deal with in life that won't be as easy as if you would choose a different path, right? And so the same thing is true when it comes to our investing. If we are after the thrill seeking, and again, this comes back to our intervention, Noah, this is for you.
Wow.
If you are thrill seeking though, you could do some really dumb things with anything. You could do it in real estate. You could do it in stocks. You could do it in just the way you spend your money. Could be reckless and, go on a spending spree and lose everything. So you could go to Vegas and gamble it all away. You have to have proper temperament and education to really put yourself on a sustainable path. But options are a critical part of my personal approach to investing in the financial markets, and I think it's one of the best things I've ever learned.
I hope our listeners take some risk in their lives. To live 80, 90 years in this world and not having taken any risks and manage those risks, that's not a life I'd want to live. Emotionally, I'm an emotional person. I laugh, I cry. It's been an Achilles heel. When emotion goes up, intelligence goes down. That tells you where I've lived my life. But it's been personal development. It's helped me gain better control over my emotions over time, standing up for myself better, being stronger, understanding, being more bold with people. Those risks are worth taking. If you have a son or daughter, you tell them to try out for the play, try out for the chess team, try out for the basketball team. Ask that girl on that date and vice versa. Take some risks in your life. And, even when you have a horrific accident like Noah's, we're so grateful that he's around because, not often there's no financial risk you'll take that's fatal, right? There's skydiving risk that might be different.
Yeah.
I'll tell you this. The final thing is we could talk for hours on this, and that's why we have the fourth pillar, risk management, and we teach that in the 4 pillars of investing. We'll put a link or something where someone can learn more about it if they want. But here's the thing about it: if you have good exit, it's like the Titanic. People on the Titanic didn't die because the ship sank. They didn't die because they had an iceberg. They didn't die because the crew was incompetent. They didn't die. They had insufficient lifeboats. That's it.
Yep.
They had no plan B. Insurance, exit strategies, position sizes, hedges, all those types of things can make investing manageable. We don't need to be afraid of risk when we're educated. So, Noah, last word on risk?
Well, thank you all for coming to my intervention. I appreciate the moral support. If it didn't want me to ski fast, they shouldn't have been telling me how fast I was going in the first place.
Yeah, there you go.
No, risk, it is... I would rather live a life with a little bit of risk than to live a life of regret.
Amen.
Of not having lived and not having taken some risks. Now, calculated risks, I think doing the calculation on the risk, understanding the risk, and the more you understand, the more knowledge you have, the less fear you'll have around the idea, especially around investing in assets that you don't have control of. Like, I have no control over how Tim Cook runs Apple. I have no control over what the market does. I have no control over the systemic risk that there is. What I do have control over is the things that you mentioned. The position size, the asset. I can do all my research, and then I can say, well, okay, I've got the options to choose from. And I can go through and I can do all these little steps and measures to help me protect myself. Now, if I can translate that into my own real life and other aspects, like skiing's fun.
Noah's he's one of the best risk managers I know with money, everything else. But if you get him in the outdoors with the ski, that's it. Other than that, Noah's like a key. Noah's good at this risk management.
Well, I got to live somewhere.
Corey, you've been one of the most important people in the Cashflow Academy, since we've been around. I just, Robert wrote a book called The Unfair Advantage, and I should pull it off the shelf and really read it. We talked about how amateurs manage risk through diversification, but professionals manage risk, as you said, through contracts. But you've been instrumental because very few people get to trade and pick the brain of a Series 4 option principle. So tell us your final thoughts on risk. What do you teach your kids about risk?
Well, like you said, you have to seek some reward, right? The on the flip side of risk is reward, and that's what we're going after. And so the idea that I'm just going to avoid risk altogether, well, that means keeping your money in a mattress, doing nothing with it, and you actually will lose in that circumstance because you're
riskier.
It's riskier because your dollar is losing its purchasing power. So you have to, everyone within the sound of my voice really has to learn how to invest. It's one of those things that really touches every human, or at least should. They should learn how to invest because that's where wealth can be accumulated. So the question is, well, how do I maximize the reward while minimizing the risk? How do I put myself in an unfair advantage where I have the edge and I have the opportunity to get ahead? And that's where options come in, because like strategies we talked about, where I can get paid to buy the asset I want at a discount to its current value, I have an unfair advantage right there. I'm getting paid income that I can utilize. I can go pay bills with it. I can reinvest it into something else. And the worst thing that happens to me is I get to buy the stock I wanted anyway at a cheaper price than its current price. Those are strategies that can be learned, can be utilized, and we can manage risks around them. So at the end of the day, it comes down to your knowledge. Do you have the knowledge to go and take advantage of those opportunities as they're presented to you? If you get the education, if you push through it, you'll learn that this can be a skill that most of the people out there with a very basic IQ and so on. I laugh when you guys talk about me being smart because I really only know two things in life. I know quite a bit about sports and I know quite a bit about the financial markets, but if you question me on other things, I'm not sure I would lose in most contests, okay? So just the things that I'm passionate about, maybe I've acquired some information there, but certainly people can learn these skills and utilize them.
Corey's got a great temperament, though, doesn't he?
He does. He's
got a
very
great
even
temperament.
keeled.
Yeah.
I will tell you this. When it comes to risk, the greatest risk is ignorance. That's your biggest risk. When we delve in things that we don't understand, I think the risk goes through the roof. You know, advice is an interesting thing because I could tell my mother everything I do, and it's actually riskier for her than it is for me simply because there's a huge knowledge difference there. The other thing I would tell you is one of the things my mentor, Robert Kiyosaki, taught me is to build my team. You know, these guys are guys I can trust. These guys are guys that I don't have to be alone. You know, think about being alone and incompetent, right? That's a pretty risky situation. So when you have a good team.
Is it worse to be in three and incompetent? I'm not sure. Three incompetence is better than one incompetence.
I don't know
how that works.
Is that multiple? What's the multiple?
I don't know. There's a square root of something. I don't know.
Yeah.
What's the multiple? But we thank you for listening. We hope you enjoy the conversation. At least it's food for thought. We're not here to tell everybody what to do, but these guys have had wonderful experience, and I've been a student of this for a long, long time, and so it's great to share what we've learned a little bit about risk. We could do 5 podcasts on this and not even scratch the surface. There's 4 pillars of investing: fundamentals, technicals, cash flow, and risk management. Risk management is by far the most important. So great discussion. It's a very risky time right now with systemic risk. A lot of systemic risk.
Indeed.
Out there, so.
Well, and you can let the fear of the risk paralyze you, or you can say, you know what? There's a way that I can learn to manage the risk. That's what gives you the confidence. I mean, it's a perilous time. It's always a perilous time. Yeah. But when you know what to do and you have that confidence, like I can control and mitigate the risk, then it makes it easier to actually take that leap of faith, right?
Sleep at night much better.
Yeah, no doubt.
You've been listening to the Cashflow Academy podcast. I'm your host, Andy Tanner, and I thank my guests, Corey Halliday and Noah Davidson, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.